To succeed and thrive at C-suite level, you need strategic clarity and operational excellence. Hello and welcome to the podcast. The subject of today's podcast is how to raise equity for your organization. And I'm going to be joined by Corinne Thompson, who is an absolute expert in the areas of fundraising, M&A, consultancy, deep tech, B2B SaaS, and many more areas besides. And if you are working in a startup or scale up, I think the value of this is immediately obvious. If things go well for you, you are going to have to contemplate numerous funding rounds, and you're going to have to get yourself organized, get your data organized, get your people lined up, and go through a pretty rigorous process to raise funds along the way so that you can continue to grow your organization. However, even if you aren't in that situation, and if you are working in a large company and you don't really have to think about that side of things, I still believe this is foundational and important listening for anybody aspiring to a C-suite role. My career, I came up through audit and through large organizations, and I didn't really know much about the world of equity fundraising and debt fundraising for a lot of the early part of my career. And I felt somewhat incomplete for not knowing more about it. And I've tried to address that in the last 10 years of my career, where I've worked in, I guess, more agile growth style companies. What you get today from Corinne is a walk through the whole fundraising process, key success factors, key steps you need to take, areas to watch. And this is all hot off the press because Corinne has just created a course, an online training course called Fundraising 101, and it's available on her website, ecapfinancial.com. I have just done the course, so early January for me is always a great time to get some early learning in, and I've completed the course end to end. Takes about 2 to 3 hours of your time, and I think I took something like 20 pages of notes from it, so still learned a huge amount from it. Corinne is great at explaining things, great at telling you what you need to do, doesn't mince her words, and I think this makes for a really interesting podcast, and I hope you enjoy having a listen. This is going to be one of 2 podcasts that I will do on fundraising. I'm going to be joined by Brendan Gilmore to talk through the debt side of things in another podcast, so listen out for that one. And finally, if you're enjoying the podcast, please do give it a like and a review on Apple or Spotify. It really does make a difference to the prominence of the podcast, and I would greatly appreciate it. Okay, over to Corinne. Corinne, welcome to the podcast.
Thank you very much. Thanks for having me.
So I'm really excited to have an expert on the show talking about equity raising. And I'm going to also have a podcast on debt raising as well. So I see these as sort of 2 halves of the same coin. And my belief is that every C-suite member, whether or not they're actively raising right now, should have an understanding of what it takes to raise equity, to raise debt. It's just a foundational knowledge that we should have. So it's going to be great to hear from you as to how it all works. But maybe to begin, Corinne, tell us a bit about your background and how you got into fundraising.
So, the boring part of my CV is I'm a qualified accountant by training. I trained with KPMG for a number of years. And then I moved into the tech space. The time I moved in was like 2013 or so, and it was up and coming. There was a lot happening, and I wanted to be a part of that. And so moved into the tech space, and then quickly realized within the sort of finance remit within tech that the areas I really loved were more of the kind of commercial finance areas, and that focused more on the fundraising elements. And that's a mixture of equity or debt financing, and then also more on the kind of like M&A transactional side of things as well. And so continued in roles like that. I would say they're like commercial FD type roles. And then at the beginning of 2023, I kind of set up on my own. And like you say, I sort of doubled down really on the fundraising element there. And it's kind of, the focus is 2 areas, as you've said, which is like working with investors, funds who are looking to invest in companies, so doing the financial due diligence for them, but then also working with these like incredible companies who are doing really kind of innovative things in the market and helping them basically get their rounds of funding secured or helping take them through like some kind of buy side or sell side M&A.
Brilliant. And I can't help just digging a little more into some of that as well, because there were some clear career decisions that you made along the way. I mean, first thing was, like me, you would have trained in auditing, and I guess you decided that wasn't for you, and you liked the corporate finance side of it a little bit more. But then also setting up yourself. Maybe just tell a little bit more about some of those decisions and junctions along the way where you made a decision to go in a particular direction.
Yeah, so I'd say what I do now with the financial due diligence for investors, or even the financial due diligence when we're looking to do some kind of buy-side M&A piece, is very akin to audit in terms of like going through the historics, but then also looking at the forecasting and what comes next as well. I think when I was, KPMG is a fantastic firm. They gave me a very good qualification. You are put through the kind of professional rigor, very intensely. And I enjoyed a lot of that. I think what I struggled with maybe at KPMG was there was just a lack of autonomy in terms of, there was multiple stakeholders within KPMG. And then you obviously have your clients as well. That is another stakeholder to add into that. And I sometimes didn't feel that I was accountable and responsible for what I was doing because there was many, many layers in the kind of KPMG hierarchy. But I do sometimes look at some of my peers that have made partner and I'm like, oh, maybe I should have stuck it out. So, that was a kind of push to get into the tech side of things. And I think I've always just sort of not necessarily listening to your gut, but wherever I think there's going to be multiple opportunities. So like new geographies, new career, new network, new people, those things excite me. And therefore actually being able to step into that is something that I, really wanted to do post KPMG into the tech space, and then basically setting up on my own. So in fairness, between a couple of roles that I was doing beforehand, I'd done a little bit of contracting work, and I highly recommend it for anyone who's looking for a new role. Actually, contracting at a company or a couple of companies beforehand allows you to see under the hood of what's going on before you then actually like take the leap and go full time. But actually this time around, when I left my last company, I was at for nearly 5 years. I thought, okay, I'll do a little bit of contracting work, but then it became more project based and it really kind of like grew arms and legs. And I was like, oh, there's actually more of an opportunity here than me then just jumping full time into another full time role.
That makes a lot of sense. And also, I suppose you must be something of a kindred spirit to the founders of the companies that you advise, because they too spotted a gap, spotted an area of growth, and wanted the autonomy and everything else as well. So it feels like a good personality match as well. But tell us about, so we've talked about deep tech and we've talked about B2B SaaS, but tell us a little bit more about the people and the companies that come to you. Where are they on their journey? What are they looking for? What are some of the characteristics? I know you'll say you don't have a typical client, but tell us about kind of where they typically are.
Oh, we really do have a typical ICP for the different sectors. I'd say on the investor side, if we're looking at that, a lot of the big investors tend to work with your KPMGs, your EYs, your PwCs. That's not necessarily where I'm going to be playing. It's a lot more on the kind of like earlier stage investors that we play more on that FDD part. And then on the more of the kind of fundraising side of things from the CFO perspective, it's typically Series A to C. Often those companies will have operational finance in place, or they might have commercial finance in place, but they just need an extra pair of hands basically to take them through a round, or someone who's gone through multiple rounds like I have, just to kind of help show the pitfalls, show the gaps, those kind of those key areas. And then on the M&A side, it's a real mix from kind of like, I'd say Series A companies acquiring other smaller companies through to much larger companies looking for someone to do their FDD for them when they're acquiring companies. And we found a kind of a real niche. I'd say B2B SaaS is a lot more of my background. Like it's what I've done more when I was like commercial FD of companies. But then deep tech, a lot of companies come to us from a deep tech perspective. And I love working with those companies. And that's not to say I don't love working with all the companies we work with. But, you're not then saying, hey, we're taking out a portion of a market. These guys are creating markets. They're creating what has never been there before. Like the capabilities and the possibilities with quantum or, hyperspectral imaging or any of these kind of new deep tech areas. And they're not even new. They've been around for a while, but these deep tech areas, I think, that I find super exciting because they're the ones they're changing society. They're changing the planet. They're changing what we do on a fundamental basis.
High risk, high reward.
Yeah. I mean, they have long cycles normally to generate revenue. They're tend to be pretty capital consuming on the process of getting there. But I would say there's a lot of grant funding, R&D funding, government funding, just in general out there in some of these spaces that means that it gives them that kind of window of time. The other thing I would say as well is like a lot of them have come out of academic institutions. So there's a lot of academic rigor and testing and experimentation that's gone into it before it hits the commercial world. And even though, again, there's still that kind of like time lag, I would say it's not just a theory that's been funded and drawn out. It's actually like a set of applied kind of practices, or like someone's PhD or thesis or whatever that's then grown arms and legs, and they've realized actually there's something bigger here than what they've just been looking at as part of their academic background.
And I promised myself I would jargon bust and I would, look for acronyms. So FTD, financial due diligence, I got that. ICP?
Individual customer profile?
You guys have an acronym for everything. And I think sometimes you think we all understand you better than we do. So I promised myself I would challenge any I didn't understand. Okay, cool. So you've given us, that's a broad swathe still of the different types of clients that you face. When someone comes to you, how do you decide if they're right for you? So what are the factors you consider when deciding whether to take someone on?
So we typically work with VC-backed companies. And, while there's a lot of, I sometimes think VC gets a bit of a bad name in certain areas, I would say VC-backed companies tend to have gone through a rigor in terms of getting all their management information, all their reporting, all their ducks in a row, basically, in terms of what they're looking to achieve, and having just that basic MI management information in place before I then begin working with companies is really quite meaningful. I've worked with a couple of bootstrap companies, and, I think bootstrap companies are amazing in terms of what they've done, and it's what I'm building. But I would also say as well, like sometimes there is a lack of kind of like financial rigor or thoughtful rigor or something, because it's all very like gut reaction, and they go where the market goes, and that's great. But like sometimes it's lacking the sort of financial kind of underpinning to it as well. So when a company approaches me, again, like I say, typically work with companies who are more kind of Series A onwards. Then I will look at like what is already in place, what rounds of funding have they gone through previously, and then based on that, I can then make a judgment call as to like, okay, is this a company that actually we've got a solid foundation on of which to build on, or is this a case of like we're building all the management information from scratch? Because sometimes the work output kind of effort on that is pretty like enormous.
And I think you also, in your course, which, by the way, I have completed, I have done end to end, you talk also obviously about the founders, and you talk about their charisma and their conviction and their responsiveness and their energy. So there's clearly something you're looking for from the founders there as well. Yeah,
100%. Like, again, we typically work with companies who are Series A onwards, i.e. they've done a couple of rounds of funding already. They could have done a seed or like a pre-seed, a late stage seed, or, some kind of convertible loan note, something like that. Like they've built their companies to a certain, even getting to Series A is pretty phenomenal for a lot of companies. And they've been able to sell in what they've got from a product perspective. They've been able to sell to investors. So, and I don't ever want to speak to a company and just be purely biased by the like charisma in the room, because there are some founders out there who, have come from more of a product perspective, and like fundraising and selling their company into investors is not their first kind of nature. But I'd say it's a mixture of things that we do look at. But actually, just their conviction of what they're building is also something that, I just find very infectious when we're looking to work with companies.
And we can only touch on it in a podcast like this, but you've referred to all the other kinds of funding that you can get, particularly pre-Series A. So there's grant funding, there's seed funding, friends and family, angel investors. And as I say, there's going to be a twin podcast to this one on debt raising. And I don't know, Corinne, if this is even possible in one short answer, but is there anything you can kind of summarize in terms of when you're talking to your clients about those decisions and about the blend of equity and debt and how those things work together?
A lot of companies come to me and they say, hey, we want to do a round of funding and this is the amount we want to raise, and we want to go out to investors and raise like capital in return for equity. I mean, I do always put on the table to them, which is like, have we thought about debt? Have we really kind of like considered what having debt in the business would mean? And for some companies, it's just an outright no. And it tends to be an outright no because, Sometimes the board is adverse to like leveraging the company from a debt perspective. Sometimes the company themselves just want to get on with an equity raise and be like, okay, we then have the money in our bank account. We're not necessarily paying it back to anyone. We're just using it to kind of like scale what we've got in place at the moment. But then for others, it's just something they've never considered before. And again, working in more of the kind of VC backed space, the debt that I typically come across is a lot more kind of like venture debt versus, say, I don't really work with companies who, have taken a loan from like Funding Circle or, those kind of, there's so many institutions out there from a debt perspective. So yeah, it tends to be quite like a niche form of like leverage that gets taken on in these companies. But it's also the size of company as well, because, a lot of banks won't touch them yet because there's too much risk involved. Their risk return profile just doesn't make sense. So it's definitely something I put on the table, but I'm not going to like push it. And like I said, and like you mentioned as well, debt comes in many forms. So I would also class like convertible loan notes or safes or ASAs as a form of debt, even though it's a blend of equity in there as well. So again, a lot of companies or founders have already considered those forms of funding, but it's something to kind of like talk through openly as to like whether we need to buy a certain amount of runway before we go out and fundraise, or whether actually we're happy with what we've achieved so far and therefore we're ready to go raise off of that. That wasn't one sentence, was it?
No, it wasn't. But it's still, it was a great answer. And it's very, it's obviously very tailored to every individual situation. So again, you go through this in your course, but I think it's worth just kind of laying out here a little bit. Can you talk us through the typical stages in an equity raise? And I know, again, we'll say like how long is a piece of string, but how long does this typically take and what does it mean for the founder? Just kind of outline for us those stages at a high level.
Yeah. So there's sometimes some thinking that sort of gets lost along the way when you're going out to do a fundraising round. And I think sometimes sort of excitement kind of overwhelms or carries people through at the beginning parts when maybe there needs to be a little bit more rigor. And so what I always say with my companies, and in fairness, I ask them this anyway, because it forms the foundation and the basis for a lot of what goes in the investor deck as well, which is like, let's think about what we've achieved between the last fundraising round and now, and really do a retrospective on like, everything that we've achieved to date: product, revenues, customer, team, advisors, board, geographical footprint, partnerships, anything that we can think of where we're like, oh, actually, that's a win. Like, let's like note them all down. And then we also do a kind of fairly basic like SWOT analysis as well, which is like, okay, as we look at the businesses that stand in the moment, like where are our strengths? Where are the opportunities in the market for us? What are the threats, i.e. competitors, things like that? And where are the weaknesses within the business that we need to kind of tweak up? And what this helps do is like, it helps many of the different work streams within fundraising. So the strengths are the things that we really want to like double down on and play on within like an investor deck, as are the opportunities as well. And this is potentially where we're going to use some of the investment money. The threats and the weaknesses are things that we need to have good responses to investors, because they will have done their own kind of like market analysis, and they will have typically come to, some of the conclusions that we've come to around the kind of like, where are the blind spots? Where are the pitfalls? Who in the market do we need to be mindful of? Like these kind of things. So that's always my starting point with founders. And then I'd say there's like key work streams that I then, not all the companies need to go through, but I do expect to come like, thoughts around that, which is the first is just getting our collateral together. So the collateral is basically at a very basic level. I always want to get in place like the investor decks, the high level initial story and pitch and what we're thinking, the financial model, which should marry very closely with the investor deck because it's the numbers version of the words version of the deck. And then the market sizing. And sometimes the market sizing is overlooked, but it's one of my favorite places to start, which is like, not a lot of investors, but sometimes in investment rounds, investors might look at a market and just be like, this is just not big enough. This is not exciting enough. Like VC is all about like high risk, high reward. And so for those that are in the very like pure VC sense, it's like, is this market big enough for you guys to take a sizable chunk of that market? And what I like doing is doing that total addressable market and then whittling it all the way down to like, okay, what's the next step in our strategy? Like which geography are we expanding into, or which like product set or customer base are we expanding into? So that's one of my starting points, but that's a work stream. That whole kind of like deck model market sizing is a work stream in its own right. The next work stream that I look at there is then around like, this is more of a conversation with companies. Sometimes they want to use advisors. So like, and when I say advisors, I mean more like corporate advisors. So someone who does more of the kind of brokerage side, i.e. makes introductions to investors. So that's like the second work stream. And for some, it's like, no, we have a strong board and they will make loads of introductions for us. Or we've got great legal counsel and they'll make loads of introductions for us. Or we've got whoever and they'll make introductions for us. The third bit is then making sure that we've got like a fundraising legal counsel in place. For Series C onwards companies, they've typically been working with someone for a while. And therefore, like, this is not a necessary work stream or a question. But for some of the earlier stage, like Series A, they may have used some kind of like regional firm who were great at the time, but are not necessarily fit for purpose because they don't have the experience in fundraising at the kind of, quantums that some of these companies are fundraising at. So I'd say that's your third work stream. Your fourth then is basically to start getting, that list of investors together. And that's basically going to your board, speaking to your board, being like, who can you make interest to? Looking at the market in terms of like things like PitchBook or Crunchbase and looking at the competitors in the market and be like, okay, who has been funded by who and at what valuation? So we get a sense of like who not to go to. And then it's also, advisors or like I say, law firms or whoever that can also help augment that investor list. Then the next work stream, so work stream 5 on this is basically like data room. Let's start getting that in order. And it's not a high priority one in terms of like investors will typically want to get into a data room fairly soon after initial conversations. And I'd say have an initial data room ready. And in that initial data room, you want the collateral that I mentioned at the beginning. So deck, model, market sizing. You probably want some more kind of like market analysis that's been done by like Gartner or Forrester or CBI Insights or like, publications that are available in the market that an investor can dig into further. Maybe things around your kind of like SaaS metrics and KPIs. Maybe some more decks about kind of your technology, your product, or sometimes I find like product demo videos very good to include in data rooms. Maybe something around your kind of like customer base, but I'd say keep it high level because at this point it's still a non-committal piece, which is an investor like they're just kind of sussing out who you are and getting to know you a bit further. And then the final bit I'd say from a work stream perspective is, and this ties in with then kind of kicking off the round, is like get a CRM system or something in place, tracking system in place, so that like you've got to treat fundraising like sales. Fundraising is sales. And it's not just the like selling of the company into investors. It's also the rigor that a good salesperson kind of demonstrates when they're working a deal from lead through to each stage of the funnel, then to closing out that deal. And you want to have that rigor in that pipeline of investors as well, moving them through the different stages.
That is an amazing list. And I think one of the real strengths of your course, Corinne, is you lay all this out for the people taking your course. You talk about what needs to be in the data room pre-term sheet, or pre-detailed discussions, and then post-detailed discussions when you've got a term sheet underway. You talk about what makes a great investor deck, what should be in it, what shouldn't be in it. You talk about, and we'll come on to some, because you talk about some fundamental mistakes as well, but you talk about the financial model and what you want to see in the financial model, but also what you don't want to see and when you can go too far. And I just found it very, very practical. One of the things as well, just as you were talking, that I was reminded that you were saying, and it was so obvious, but I can see people making this mistake. When people lay out their financial model and their funding gap and that kind of thing, and they say, well, therefore, that's what we need to raise. Some people stop there. I mean, they literally say our funding gap is X and that's what we need the money for, versus the hugely important piece of saying, if we get this money, this is what we're going to do. This is the market we're going to go into. These are the people we're going to hire. This is the R&D we're going to do. And so obvious, like I say, but I'm guessing a mistake that's made quite commonly.
Yeah, I think people put together these models that show these kind of like funding gaps. But if you take a step back, an investor wants to know what their money's going into. Like they're investing in something. They're investing typically in top line growth, and that top line growth will come from hiring new salespeople. It will come from marketing. It will come from like international expansion. It will come from like building out new products. It will come from these areas. And you need to kind of showcase those and articulate those in the financial model. So you do yourself a massive disservice by just stopping at what the funding gap is and not showing what the consequence of taking investment is.
And are there any other mistakes that you want to highlight here, mistakes that you see when people put together their financial model?
Just making it too complicated. It's financial modeling, it's an art, not a science. And it's based on a set of assumptions that, okay, you need to defend, but at the same time, they don't need to be every single assumption under the sun. It needs to be the key ones that are the key kind of value accretors in the business that you need to, showcase and pull those out in an assumptions tab. Sometimes I see financial models that are 15, 20 tabs long, and I'm still confused as to how much money we need to raise and when that investment is going to happen and what is this kind of just the summary P&L cash flow at the beginning, the first tab. Just show me annually what we're going to achieve from a revenue perspective. Show me annually what happens to EBITDA. Show me annually where within sales and marketing, R&D, OpEx, show me what's going to happen to each of these kind of cost investments, but show me aggregated. There's a lot of thinking that goes into it. There's a lot of detail. All the detail gets split out onto many tabs, but rolling that all up into one tab, it's here's a summary. And one thing I always do, and I talk quite highly of, I think it's necessary, is investors are economic animals. They can make their way around a kind of financial model very easily, but make it easy for them and signpost things and guide them. Do a screen share overlay on top of it and actually showcase to them, okay, tab 1 shows you this, tab 2 shows you this, tab 3 shows you this. This is where you'll find the P&L. This is where our balance sheet is. These are where our key assumptions are. Bring it all together for them so they're not spending hours upon hours of their life trying to navigate your model.
Yeah. Make it easy in a competitive market, make it easy for people to see what they need to see and draw their attention. Absolutely love that. One of the things, Corinne, when I was going through the course, first of all, what drove home to me was you need a huge amount of stamina to go through an equity fundraising round. And I guess to have got there in the first place, and as you say, to have got to Series A, you need to have worked incredibly hard and achieved an awful lot. And then what we're talking about is probably, I think on average, you sort of said kind of 5 to 8 months, obviously can be shorter, can be longer, but that's sort of atypical to the extent there is period of time. So you need this stamina. You need to be super responsive to the questions from your prospective investors and so on. But then even when the terms are agreed, and this was something that I didn't appreciate. So even when you've signed and everyone is celebrating and so on, you're still not done, are you? There's still a whole post-signing series of things to be done. Talk us through that.
So you'll sign initial term sheet saying that you're into some kind of binding agreement with the investor. And typically at that point, due diligence starts. So this is what I do on behalf of investors. But this is also what happens to me as well when I'm working with companies who then go through the due diligence process. At these points, it's not just financial due diligence, it's legal due diligence in all cases, it's legal due diligence. In some cases, it's tech due diligence. And it depends on the size of the company. So some investors will let loose your kind of KPMGs or your big four onto some of these companies. And if that's the case, you're going to get hundreds of questions being fired your way on many different work streams, from tax through to legal through to, all sorts of pieces. And then in earlier stage companies, it tends to be a little bit more sort of high level due diligence. But yeah, this is the part where you really need to speed up. And this is the part where it often gets handed over to back office. And sometimes back office are somewhat underprepared for what is coming in terms of, what I often say with founders is if you've made any assertions or assumptions in your investor deck and your financial model, sit with your team who will then be doing the DD and talk them through that. Everybody needs to be saying the same story. Everybody needs to make sure that all their ducks are aligned on these things. So, but at this point in time, this is the bit where you really speed up, because what you want to do is get through this just as quickly as possible. And it's going to involve your poor financial controller, your FD, your CFO, whoever it is, burning the midnight oil, just getting information back as quickly as possible, so that it keeps going and it keeps moving through, because time kills deals. And it's not necessarily time that kills deals. It's the lack of momentum. And you don't want deals to fall apart at this point when you've already done all this initial upfront legwork to get you to the point where you're okay, cool. Here we're at term sheets.
Corinne, as someone who works predominantly in operations and risk, I spend a lot of my time saying to the front office or the revenue generating arm of the business or the CEO to say, please involve your people, involve your stakeholders, involve your operations team and your compliance and your legal team. One would hope that the first time that financial model gets shared with that team is not post term sheet signing, right? It should be, and you lay this out again in your course. At the very beginning, that first strategy step that you said, you've got to have the important people, the key people in your organization around you to say, look, we've got to lock hands on what we believe, the organization can achieve, on the funding gaps, on the key priorities, so that when you come to them and say, right, now we need 500 bits of information, they're ready and they know, and everyone is telling the same story.
And one of the ways to do that up front is to start populating your data room early and get everybody involved in data room population, putting their stuff in the data room so they know what's coming. They know that kind of this is the information that they've shared. Like, you know, it gets buy-in. People understand what's going on. I can see it from both sides. Like sometimes founders predominantly run the rounds, even into later stage rounds. They predominantly run the rounds alongside then their CFO. And I would say it's so draining that then, you know, stakeholder managing investors and then stakeholder managing internally, like it's a big undertaking. And so I do get it sometimes where they're like exhausted and the last thing they want to do is, you know, answer a myriad of questions that may not even be relevant yet from their internal team as to like, you know, status. And the other things I would say is sometimes you just don't want rounds getting out to anyone external to the company unless you're actively in the market fundraising. And so the fewer people who know and it's your inner circle and it's people who kind of like all get what's going on, I sometimes think the better rather than, you know, the general organization asking questions around whether we're going to run out of money or whether we're going to, you know, is salaries going to be met for the month, even though that's never been something to call into concern. So, but yeah, I would say for those who are going to be heavily involved in fundraising, like from the beginning, everybody needs to be saying the same story.
I absolutely get the not democratizing the fundraise, because that is something that's usually the preserve of a small number of people at the top of the organization. But democratizing and sharing the strategy, the success factors, what you're going to do next, and that kind of thing, it, you know, clearly makes for a smoother path. This podcast is brought to you by the best-selling How to Be A range of books. These books, authored by me, Jennifer Geary, in collaboration with other seasoned experts, break down roles such as the COO, Chief Risk Officer, Chief People Officer, and Chief Sustainability Officer into their component parts. They explain the technical capabilities you need, but also how to operate at this level, preparing yourself, getting to know your peers, engaging with culture, strategy, building your team, and much more. Over 30,000 books have been sold, and the books have received overwhelmingly positive reviews. There's even a book about the role of AI called The Augmented COO. Check out the books, available on Amazon and Waterstones now. So, Corinne, it's early 2025 as we record this. Tell us about, as you look at the market right now, as you look at the dynamics, you look at the US, you look at Europe, you look at the UK, what are the factors that are going to shape the VC and capital raising markets in the coming year?
There's a lot of M&A on my plate right now and a lot of proposals out from like an M&A perspective. So there seems to be a lot of consolidation happening at the moment. Like if I kind of break it down and think about it, like more sort of like the different sort of segments from a geographical standpoint, like the US continues to be where big valuations lie. The US continues to be where there's a lot of capital being deployed. That was the case in the Middle East, say like, I don't know, 4 years ago or so, 3 years ago. But I'd say the Middle East is more doubling down on like well-known brands and like your bigger institutions, so less risk capital there. I'd say the US tends to be like still your go big or go home type capital, so like really riskier capital. I never want to do, you know, the shores of which I live on a disservice, but sometimes I am just disappointed by the kind of lack of, sometimes what it just feels of like excitement, momentum, willing to take risk or willing to actually be what VC is meant to be and have that appetite for VC. And that's not to say there's not European investors out there who definitely play by the VC landscape and book. Deep tech needs a heck of a lot more funding deep tech is where you're really going to move the needle on things. And I love listening to Harry Stebbings, 20 VC. And he interviewed the head of NATO Innovation Fund, who's also the founding partner of Lightspeed. And he was talking to the fact that like there's just a dearth of capital going into deep tech at the moment. And we really need to kind of change that. And there's certain sectors as well that people don't want to talk about, but need funding. Security, we call it security, I mean defense, right? It's a big area which is highly underinvested in, particularly in Europe. So why don't we just get over the stigma of talking about defense and security and just say we need it? So like we need to invest in it. I still see Europe kind of like a little lagging behind, say, like the US in terms of like Asia, like areas like Japan are really like on the front foot now, just because they've been on the back foot for a little while. Like, you know, the likes of like Sony Innovation Fund, for instance, is deploying, you know, quite a bit at the moment. So again, like parts of Asia are really sort of like stepping on it. The only thing I would say is sometimes my experience with Asian investors is like the deals tend to take a little bit longer than they do say in the US, where it's a lot more like transactional in nature. I'd still say that, you know, operating in the VC scale up space is a good space to operate in. There are some funds who have struggled to raise fresh capital themselves. So sometimes capital is a little bit more in kind of short supply, but sometimes there's nothing wrong with that in terms of you're really then investing and doubling down on what they perceive are the best versus just what happened in 2021, which is like a lot of things got funding, which you would maybe argue is not like a VC type industry or a VC type company to invest in. So I'd say like I am optimistic of 2025, got a lot of M&A happening, already had a fairly big fundraise like kicked off this year. So it's getting a lot of traction. So yeah, I feel pretty optimistic about this year. I mean, maybe we'll speak at the end of the year and I'll be like, oh my gosh, it was a car crash. Yeah.
It does feel much harder to predict, I think, than other years. But I second your point on defense and security. I mean, we know that in Europe, we're going to be forced to spend more on our own security. And therefore, by definition, that has to be a growth area in Europe. And I mean, nobody likes making losses, of course, but the loss aversion does feel very strong here, you know, perhaps a little overly strong versus the what if and we can, you know, and the optimism, as you say. So, but interesting to see how it all pans out. Corinne, I've got two questions left. One was, tell us why you made your course. What prompted you to do that?
Yeah, it's a very good question. It's one of these things where like it's been sitting in my head for a little while. And sometimes you get things that are sort of put in you that need to kind of come out. And like this just needed to come out, and it needed to come out in the format that it came out in, which is like a very kind of like clear view of what fundraising actually entails. Because there's a lot of crap out there, and it really angers me and it really upsets me sometimes that sometimes people spend money on things that, you know, it just not really move the needle forward for them because they're dealing with people who have certain titles but don't necessarily help on fundraising or have not got that huge amount of experience. And so, you know, teaming up with Matt Bradley, like Matt is a serious operator in the industry. He is phenomenal. He used to be the CIO of Forward Partners. He was the CFO, took them through their IPO. Like he dealt for, I think, 7-8 years as an investor with companies. And I think, you know, between myself, who's more on the CFO side, and him, like it was a really good combination of like skill sets coming together to be like, we've seen it from both sides and here's everything out there. And I think it's also one of those things where I just want to keep adding to it as well. Like there's no module on there specifically on deep tech. That like, I'm definitely going to do one there. Like I want to do some like real worked examples of like, here's how you build a Tam Som from scratch. So like, you know, so that people have physical, tangible things that they can go away and they can work with. And then I think the final thing, and the reason I built it was just because I've benefited personally from other courses, and I've invested quite heavily in, you know, books, podcasts, e-learning, like all this kind of like learning, and invested in myself and my skill set. And, you know, I kind of want to put back out there what I wish I'd known 10, 13 years ago when I was like faffing around on YouTube trying to work out how I build a financial model for a fundraising round. So yeah, that was basically it.
And for what it's worth, Every single one of my 5 books, I felt exactly the same. Like I felt it was in me, there was a concept there, and I kind of wasn't going to rest until it was out there. And clearly that resonated with you as well. Very good. This has been so helpful. And I'm going to finish by asking you what one thing you say to your clients more than anything else.
Fundraising is sales. Like I've said it already here, and I will repeat it until I'm blue in the face. And I don't say it lightly, but founders have done a phenomenal job of building the companies they have. It takes so much resilience, so much going through crap, so much effort, so much everything basically to get to the point where they have like monetized, products, subscriptions. They have built things that were never there before. They have formed teams. I don't think people quite realize I think, entrepreneurship sounds sexy. It sounds fun. It sounds all these things, but like, it's actually a hell of a lot of crap that you have to wade through with some highs along the way. And I think when I say fundraising is sales, and I say that to my founders, talk about everything that makes us amazing. Talk about everything that we've achieved, but also talk about why we're going to win. And we are going to win. And these are all the reasons we're going to win. And like, get that out of you onto a page, into investor ears. Like, because when I think people start talking like that, they really showcase their charisma behind it. They really showcase like why they were actually, formed, why they have put themselves out there. And so it's not a twee line that I say just to be like, oh, you got to go sell your, vision or your team in. It's remember everything you've gone through and use all that now to like showcase where you're going to go to next. So that's my key line.
What I take away from this, and so much alignment with how I think as well, start with strategy at the very beginning. Start with the strategy of your organization. Keep it simple. Be responsive. Find the right people. Align your team. Manage your data. And keep the momentum going. And, everything in your course is so common sense, but it's delivered at the right point when you need it along the way. So, Corinne, Fundraising 101 is available via Teachable on ecapfinancial.com, and anybody considering an imminent equity raise, or frankly, just wanting to know more about how this world works, would do well to invest the time to do it. Corinne, thank you so much for coming on the podcast today. It's been great to have you.
No, thank you very much for having me. I really appreciate it. Thanks.
We hope you enjoyed the podcast. For more information about the How to Be a books, the C-Suite Framework courses, the podcast, or to get in touch with me, head over to www.csuiteframework.com.